Gary, I just want to pick it up on that last point. It is interesting that even if you've got some defensive names or sectors that you want to take a look at, I mean, there is risk to their profits as well. In other words, those stocks can also go down. Do you want to maybe weigh in a little bit in terms of what you're seeing on the employment front and how companies are acting and reacting these days?
Well, let me just say before I get into that, in more direct answer to your point, if you look at the S&P 500 stocks, there are 10 different categories that they use, and you look at bear markets associated with recessions in the past over the entire post World War II period, and all of them went down. Now, some of them, the so-called defensive stocks, did better than the average. Utilities, healthcare, consumer staples, three defensive areas, but they all went down. So, losing less money than the average is not my objective. But in any event,
Understood.
go
Yeah.
ahead.
And Gary, I wanted to stop on one point, on exactly that point. I believe a number of years ago, pre-pandemic, when I interviewed you, you said it is also important. A lot of people don't look at it this way, but how important it is if you look historically to avoid those areas. Even though they're defensive, they're just losing less money than something else, but that doesn't help you make money at the end of the day. And I think you pointed that out in one of your notes many years ago.
Well, yeah, and it, Catherine, it really is what I call grade school math, and it's trivially obvious, but boy, is it powerful. And it simply says this: if you lose 50% on a investment position, you've got to make 100% just to get back even. I mean, that's simple grade
Yeah.
school arithmetic. But it really means that avoiding losses is actually more important than making gains. And we've done extensive studies over the entire post World War II period of looking at the U.S. stock market in particular. And it really is true that if you can avoid losses, if you can avoid bear markets, you can give away a lot of the increase in following bull markets. You can be late in getting back in as long as you avoid those losses. So it's just grade school math.
It is, but I don't find that correct me if I'm wrong, but I don't think Wall Street traditionally looks at it that way. And that's why I remember this comment of yours from years ago.
Yeah, well, that's right. But bear in mind that uh, Wall Street people are basically paid to be bullish. And I know from my own experience that being bearish can be detrimental to your job security. And I think you know the history that I was fired twice by Don Regan of Merrill Lynch for being bearish but correct on the economy and stock market. And I'm not alone in that area. So you have to investors, I think, have to particularly be aware of the biases that Wall Street prognosticators proclaim,
Hmm.
and realize that they're paid to be bullish.
Yeah. I think that that's a really important point. I mean, I know I always err on the bullish side, but I'm always looking for where that will be wrong. So let's maybe continue that part of the conversation in terms of some of the areas that you see have significant risk, and we can talk globally. We can talk about China. What are you seeing there?
Yeah, well, China is the second largest economy in the world, as we all know, but it's because it's got a lot of people. And China's GDP per capita is about 12% that of the U.S., for example. So it's really a very underdeveloped country with a lot of people. And of course, the Chinese, with a top-down political and military regime, they can put their weight where they want to, and they're doing that now, and they're trying to expand commercially and militarily. But China right now is really in a very slow growth pattern, and they're not providing much support to the rest of the world. Their property sector has not revived. Consumers are cautious. The government has not unleashed massive fiscal stimulus. They may, but at the moment, China is really just not doing much for the rest of the world, and the rest of the world isn't doing much for China.
Hmm. What do you think that means then in terms of global growth? What would be your range that you're looking at? Because that does impact Canada as well, of course.
Well, I think global growth. Now, of course, you have some of these developing countries where 6% growth is a recession, but I think we're looking more like 2 or 3% maximum.
Okay. Okay. We'll take a quick break. We'll be right back.